Real Asset Management has recently launched a series of global multi-asset portfolios in response to demand from high net worth investors. Here to tell us more about why this approach is increasingly appealing to clients is Real Asset Management Australian Chief Executive Scott Kelly. Scott, thanks for joining me.
Pleasure.
Now, Scott, why do you believe that high net worth investors are increasingly demanding more globally focused investments?
I think if you look at the history of asset allocation in this country, it's been dominated by three asset classes: term deposits, Aussie equities and Aussie property. And with good reason. I mean, why would you buy a bond when a term deposit gives you a real return of 3 to 4%? Aussie property, Aussie equities have delivered strong returns for a very long period of time, and added in the added bonus of tax benefits. That's a very attractive proposition for investors, particularly Australian tax-paying investors. So what's changing? The things that are changing basically are an adjustment in the expected returns of those asset classes, particularly relative to global asset class returns. So diversification is becoming more attractive to Australian investors generally. They've also, if you look at the Australian market, if you take the equities, for example, a lot of the key sectors, number one, they're narrow, there's a narrow exposure, and number two, they're fully valued. So, for example, the banks are fully valued. If you also look at the resources sector, you know, that's been a secular change in growth patterns for the resources sector. So there are certain reasons now why it makes more sense for Australian investors than it ever has.
And tell us about the bespoke approach that you employ when it comes to constructing multi-asset portfolios for your investors.
Well, for us, it comes down to three things. Firstly, as our name suggests, we embrace real assets in our portfolios, and we blend those with financial assets to deliver a strong return for clients above the rate of inflation, and we do that in a very controlled and methodical fashion. So embracing real assets in both the advice process and the investment process is key, particularly for entrepreneurial clients and wealthy families that we found have a natural bias towards property. Around about 40% on average is the exposure to direct property if you look at Australian high net worth investors. So that's really the principal reason. Secondly, spending 24 years almost in big organisations, I know it's difficult to build genuinely bespoke portfolios for entrepreneurial clients. Typically, you just want scale in those organisations. So having a smaller number of larger clients means that we're able to build genuinely bespoke portfolios with interesting products that appeal to entrepreneurial clients. And then finally, it's about reducing the risk and having a more granular asset allocation mix, and not simply just adding in Aussie equities with US equities, for example, but far more granular global asset allocation to really spread that risk. And I think in 2018, that's going to be even more important than ever.
And in terms of the sort of tactical tilts that you're taking, what kind of asset classes do you like at the moment?
So as we move into 2018, we see the world in a very positive light. Why so? Because if you look at economic growth around the world, it's not only strong, it's unified, and it's accelerated through 2017. So 2016 we had 3.1% growth, 2017 is 3.8%, 2018 the world will probably grow at around about the same amount, 3.8 to 4%. So that underpins strong earnings, which have also been growing, and that confidence is coming through in CapEx. So as companies are more confident, they're investing in their own business, which leads to productivity and growth gains. So that really underpins our positive view of the world. So in that environment, we're very happy to be overweight risk assets such as properties, such as equities. If you look at the sort of counterbalance to that, the other side of the coin, what are we worried about? Well, we're worried about quantitative easing coming to an end. So we've had a flood of liquidity moving into typically equity markets for a long period of time that's kind of pushed them up. So we think that markets might be a little bit more volatile, and you'll have to discern between good equities and bad equities, because it won't just be kind of pushing everything up at the same time. So what does that mean for our portfolios? It means we're looking for strategies like global macro that do well in times of volatility, that long-short equity managers are driven by stock selection, we think will do well in 2018. So those are really the key elements globally. When we look domestically, the thing that we're kind of worried about a little bit is valuation of the equity market. So globally, valuations are okay, about the long-term average, about 18.3, something like that. But in Australia, that's kind of higher. So whilst we're very positive on the Australian economy, you know, liquid gas coming online, infrastructure spend, you know, those stories are well known. We're a little bit worried about Aussie equities. So we prefer to take our exposure to Australia through defensive commercial property, and also as rates rise in Australia and most other places, floating rate, low duration credit is the way that we prefer to take our exposure to Australia. So those are really the key features of our portfolios right now.
And how big a role do real assets play in the portfolio that you would construct for a client? Obviously, you said that commercial property in Australia is a big holding for you. What other sort of real assets would you use?
So we have a neutral rate, depending on the client's risk profile, we have a neutral weight of about 18% in our portfolios. That's comprised of property, both Australian and global, also other assets such as infrastructure, and I'm very keen on that at the moment, bearing in mind my comments previously about the Australian infrastructure landscape. So those type of assets, along with private equity, we see we're really positive on those. We think private equity will outperform public equity going forward, as it has done always historically, and the extra risk is worth taking. So overall, we're overweight that 18%, probably by 2 or 3%, depending on the risk profile of the portfolio.
And are there any risks or downsides to a multi-asset approach, for instance, you know, going into sort of more high-risk markets like private equity?
Yeah, I think, you know, fundamentally it's about reducing risk, right? So diversification, so-called the only free lunch in finance. So having more diversification is good. I think if you look at what are the potential risks of doing that, well, if you look at exposure to currencies, that's an obvious one, but that might be a risk worth taking if you look at the returns from international investments for Australian investors the last 5 years or so. They've been enhanced dramatically by taking currency risk. So ultimately, diversifying internationally is about reducing your risk, not increasing it.
And do you think that multi-asset strategies are going to become more popular among high net worth investors?
I think they already are. I think that trend is well entrenched. If I look at the last 5 years and I think about my time over the last 24 years, I think Australians will move gradually towards the global norm of having a far more diversified portfolio. And if I look at the stats, the wealthier clients, so those are 10 plus type of portfolios versus the 1 million and below type of portfolios, the wealthier clients who receive more advice typically have a higher weighting to international assets of all varieties versus the clients that have less assets and receive typically less advice. So if you look at that evolution, it's very much on train, and it's driven by the factors that I mentioned earlier, so yes.
Great, Scott, thank you very much for joining me today.
Pleasure.